Good day, this is the last in a four-part series on leverage and capital structures. In this session we'll look at the pecking order briefly, the earnings before interest and tax and EPS approach, as well as then try to determine the optimal capital structure. Okay, so the pecking order theory says that there is, irrespective of what all the theories say, there is a specific preference in terms of the types of funding that a business would use, and they are then listed by the company, and in most cases they are very similar from company to company, and the companies would then exhaust and use as much as possible from the first before they then move to the next source in the pecking order. And the pecking order normally starts off with retained earnings, because they are the cheapest. You don't have issuing, flotation costs, nothing, and it's money that's already in the business, so you use that first. Then obtain specific debt from the from your financiers, especially from the suppliers, etc., and from financial institutions. Then the more expensive convertible debt that is eventually converted into equity, and the last two would then be the preference shares, which has a preferred treatment and more regular obligations in terms of the cost of the preference shares. And then equity shares would be the last source in the pecking order, because they often require the highest return because of the level of risk that the investors take in the business. Depending on what the business then use, will also have a signaling effect into the market. What does that mean? It means that if a business uses debt to fund their new projects and their new growth, it signals to the business community and to the investors in the market that the company and management in the company is confident that they will be able to service the debt, and that the debt providers are comfortable that the debt is fair, and that they will get their returns, and that they are acceptable of the risk, and therefore it will be a strong message for the business to the investors, and that will attract further investors into the business. But if they go to the equity issues, that would signal to the market, in most cases, that the management do not think that they are as strong to service the debt, and therefore they request the equity shareholders to fund the business further. And you will see during especially these last few months that companies like Sasol and a few other companies, I think City Lodge and one or two other companies, has issued additional shares during this very difficult financial times, which then signals to the market. And if you look at the performance of the share prices, it significantly dropped because of exactly this signaling effect and the confidence that it brings to the market or not bring to the market, depending on what the source of funding is that management picks. Earnings before interest and tax and EPS. The approach here is that EPS is a sign of how healthy a business is, and therefore the bulk of the major focus of a business should be its earnings per share. And the way to do this is basically looking at different debt to equity structures and what the impact of that is on earnings per share, and then plotting that on a graph and finding indifference points, which would then be reading from the graph the optimal capital structures where earnings per share is then maximized. Criticism is that there's too much emphasis on maximizing earnings per share and that there are other things that's also important. Cost control in the business has a direct impact on earnings per share. Risk minimization has to be considered, and that does not reflect in earnings per share. So there are some criticism around these methods as well. So ultimately what we see in all these methods, these are attempts and methods to determine and further understand the capital structures, but there is not a one point that is valid for a significant period of time. It's a dynamic environment, and the best would be to analyze and try and understand the optimal point and the optimal range, as we saw in the Miller and Modigliani environment. Okay, so what is the linkage then? And that is to measure the impact of the change in the financial risk on the change in the shareholder value. So ultimately what a business wants to do is to increase and maximize shareholder value, and there needs to be a link between these models, understanding the financial risk, and which is the capital structure, and the shareholder value. There are two basic approaches. The one is the theoretical approach, which basically translates the financial risk into the beta of the company, and the beta would then be adjusted as the financial risk increases or decreases, and then apply the capital asset pricing model to determine the required return on equity. The other approach would be linking the financial risk directly to the return on equity, and that is through an adjusted discount rate. And you will remember that the calculations on risk-adjusted discount rates, and using that then to determine the optimal returns. Other considerations that also plays a role are the business risk, and the elements contributing to the business risk should be considered. The tax exposure of a business, the business with where the tax rates are higher, operating in areas where tax rates are higher or lower, then have a direct impact on the after-tax costs of the debt, and therefore the contribution of debt or not towards the capital structure. The flexibility, how flexible the business is in terms of raising funding, agency costs, and what restrictive measures are imposed by the agency costs. The market conditions, in good market conditions it's easier to raise funding and raise debt. Sometimes in difficult conditions like early 2020, conditions were very difficult, and then it might be more difficult to raise debt, and therefore the company doesn't have an option than to go to the shareholders. Asymmetric information, that is where funders from outside, the banks or other funding institutions, do their own analysis on the risk of the company, and their perception would then be driving their decision on the funding that they are prepared to provide. And then the company growth rate. Companies normally in an early stage of the company's existence will have higher growth rates, and at later stages in the company will the growth rates flatten off, and therefore that will also contribute towards the ability or not of a company to raise funding. So that brings us to the end of this series of 4 on the capital structures, and we thank you for listening and enjoying this with us.